Did you know that 63% of first-time homebuyers regret their purchase? I don't want you to be part of that statistic. So in this video, I'm going to show you how to avoid the costly mistakes that lead to buyer's remorse and financial strain. Let me tell you, buying a house is a big deal. It's probably the biggest purchase you'll ever make. And here's the thing, it's easy to let your emotions take over. Trust me, I've seen it countless times, over and over again. A buyer falls head over heels for a house with a beautiful kitchen or a spacious backyard, only to overlook significant issues like an aging roof or an outdated HVAC system. But I promise you, there's a better way. The key is to stay objective. Before you even start house hunting, I want you to create a checklist. Write down your must-haves and your absolute deal breakers. This will be your guide when you're touring homes, helping you stay focused on what really matters. Remember, a house isn't just a home, it's an investment, and making smart decisions now can save you thousands in the long run. Okay, so you've created a checklist with your must-haves and deal breakers, and you're feeling prepared. Great, but there's another hurdle many buyers face, one that can make or break your home buying journey. Think you know the difference between a pre-qualification and a pre-approval? The answer might surprise you and save you from a major financial misstep. Let's talk about pre-qualification and pre-approval. Many buyers think that they're the same thing, but they're not. Pre-qualification is just a quick estimate of how much you might be able to borrow. It's based on the information you provide, and it is not too reliable. Pre-approval, on the other hand, is more serious. The lender not only checks your credit score, but verifies your financial information. This will give you a more accurate idea of what you can borrow. But here's the thing, getting pre-approved doesn't mean you can afford that amount. I've seen buyers fall into this trap time and time again. They get pre-approved for a certain amount and think, awesome, this is what I can spend on a house. But hold on, that pre-approval amount doesn't take into account your actual budget or lifestyle. Remember, lenders are focused on what you qualify for, not what you can comfortably afford. They're not thinking about your weekend plans or that yearly family vacation. That's on you to consider. I want you to think beyond just the house you want to live in. Think about the life you want to lead. Can you really afford that pre-approval amount and still have money for the things that make life enjoyable? That's where understanding different mortgage options becomes critical. A fixed rate mortgage might offer stability, but an adjustable rate loan could save you money up front, but comes with future uncertainties. FHA loans may require a lower down payment, but comes with additional insurance costs. USDA and VA loans offer 100% financing and specific benefits, but they have eligibility criteria you need to meet. You see, each loan type has pros and cons that can significantly impact your financial health over the long term. That's why it's so important to understand the different loan options available to you and choose the one that fits your personal needs. Your mortgage should fit into your overall financial plan, not dictate it. Take the time to weigh all the options and make sure your loan aligns with both your current budget and your future goals. By the way, if you're finding value in this video, could you do me a huge favor by liking, leaving a comment, and even better, subscribing? I'm on a mission to get to 1,000 subscribers before Thanksgiving. Okay, now back to the video. Remember when I said smart decisions could save you thousands? Well, here's where the rubber meets the road. Think you know how much that dream home will really cost you? The answer might shock you, and it could make or break your homeownership journey. Let me tell you, many buyers focus solely on the listing price, missing critical financial factors that can turn their dream home into a money pit. A buyer gets excited about a house only to realize they can't afford the true cost of homeownership. When buying a home, it's important for home buyers to understand that while they may obtain a 30-year fixed mortgage, property taxes and insurance are not fixed. This means that even though your principal and interest portion of your mortgage payment stays the same, your total monthly housing payment could increase over time. For instance, property taxes are based on the assessed value of your home, and if your home's value rises, your taxes can be reassessed to reflect the new market value, resulting in higher property taxes. Similarly, homeowners insurance, which is required by lenders, can also go up. The cost of insurance is influenced by factors such as the value of your home, coverage levels, and changes in risk factors like weather conditions or natural disasters in your area. It's crucial to factor in these potential increases when planning your long-term budget because they can impact your monthly payments even if your loan remains at a fixed rate. And we're not done yet. Don't forget about ongoing maintenance, unexpected repairs, and utilities. These costs can add up quickly, contributing to the overall financial responsibility of homeownership. Now, I don't want to scare you off. Buying a home can be a great investment when done right. The key is to avoid becoming house poor. That's when most of your income goes towards housing expenses, leaving little for other necessities or even savings. So how do you protect yourself? Start by saving more than you think you need. A good rule of thumb is to aim for 6.5% to 7% of the home's purchase price to cover for down payments and closing costs. But don't stop there. Create a detailed budget that accounts for all potential costs of homeownership, including mortgage payments, property taxes, homeowners insurance, regular maintenance, and unexpected repair emergencies. Planning for these expenses will help you ensure you're financially prepared, not only for your monthly payments, but also for any unforeseen costs that may arise. Remember, it's crucial to conduct your personal research on what you can afford based on your lifestyle. Don't rely solely on what lenders or real estate agents tell you. They might have their own interests at heart. Now that you're armed with knowledge about mortgages, let's talk about the art of the deal. What if I told you there's a way to potentially save thousands on your home purchase that most buyers never even consider? It all comes down to understanding the seller's situation. Let me tell you, strategic negotiation in real estate can be a game changer. I've seen buyers miss out on incredible opportunities simply because they didn't do their homework. One of the biggest mistakes, failing to research the seller's situation or the property's market history. Here's the thing. Knowing how long a property has been on the market can give you a significant advantage. If a house has been listed for a while, the seller might be more willing to negotiate. You see, every day a property sits unsold, it costs the sellers money. I want you to think about this. A property's market history isn't just a bunch of numbers. It's a story. It tells you about price reductions, how long it's been listed, and can even hint at the seller's motivation. This information is gold when you're at the negotiation table. It's not just about the property itself. Understanding the seller's situation can give you an advantage in negotiations. Are they in a hurry to sell because they need to relocate for a job? Are they already under contract on their dream home and need to sell their current home quickly to avoid losing it? These factors can make them more flexible on price or terms, giving you the opportunity to negotiate a better deal. And here's a pro tip. Don't be afraid to ask the seller for concessions. In a shifting market, you might be able to get the seller to cover all your closing costs, reducing significantly your upfront expenses. Hey, it's all about negotiation. Remember, real estate agents can offer valuable insights into this process. They understand local market dynamics and can help you craft a strategy based on the seller's situation. But don't rely solely on your agent. Do your own research too. Now, here's something your real estate agent might not tell you. There's a hidden superpower in the home buying process that most people overlook. Can you guess what it is? It's the power to walk away. That's right. Sometimes the smartest move you can make is to step back from a deal. Let me tell you, I've seen buyers get so caught up in the excitement of finding a house they love that they ignore red flags. They feel pressured to accept unfavorable terms, afraid they'll lose out if they don't act fast. But here's the thing. Being willing to walk away can actually lead to better opportunities. Remember, the most powerful tool in your home buying strategy is not what you think. It's not your budget, it's not your credit score, or even your negotiation skills. It's your ability to recognize when a deal isn't right for you and you have the courage to walk away. I want you to think about this. Every time you consider a property, you're making a business decision. It's not just about finding a place to call home. It's about making a sound investment. That's why it's crucial to set clear boundaries before you start your search. Here's another pro tip. Learn to recognize the signs of a bad deal. Is the seller inflexible? Are they refusing to negotiate on major issues? These could be red flags. Don't let emotions cloud your judgment. If you walk away, you might find that the seller comes back with a better offer, or even better, you might find a property that truly meets all your needs. All right, let's wrap this up with your blueprint for smart buying. Remember all the key points we've covered: being smart about pre-approvals, staying emotionally detached, understanding the true cost of homeownership, negotiating strategically, and knowing when to walk away. Here's one last piece of advice. A house is both a home and an investment. You need to balance your dream with smart financial decisions. Don't let emotions cloud your judgment, but don't ignore them either. Find that sweet spot where your heart and your wallet align. Now that you're armed with this knowledge, you're ready to navigate the market like a pro. Take your time, do your research, and don't be afraid to ask questions. Remember, the right house is out there waiting for you. So good luck with your house hunt. Oh, and please don't forget to subscribe. Every single one counts. Until next time.